and welcome to this episode on Winding Up. We're going to be dealing with Chapter 20 of the Companies Act 2013. To discuss this very important chapter, we have with us Senior Counsel Mr. U.K. Chaudhary, who's also former President of the ICSI.
Yes.
We also have Ms. Vijaya Sampath, Senior Partner Lakshmi Kumaran and Sridharan. Can we begin this discussion by broadly talking about what the Act does on this subject of winding up? What are the modes of winding up? How does it deal with this aspect of company law?
See, the entire chapter is divided into two parts. The first one is a winding up, for which the process starts by filing a petition before the tribunal, which is National Company Law Tribunal, established under the Companies Act 2013. The second process starts with a voluntary decision taken by the company, primarily at the board of directors, and then convening a meeting of the shareholders where they can either decide that the very objects of the company for which it was incorporated has either become over,
Right.
or the objects of the company have been fully fulfilled and therefore there is no need for the company to exist. They can also pass a special resolution to decide that the company need to be voluntarily put to winding up.
Right. So the members would do it of their own
The members
volition.
the board will decide,
Right.
and the board will convene a meeting of the shareholders. For the first purpose, it will be an ordinary resolution. For a second purpose, when the company is an ongoing concern but need to be put to the voluntary winding up, it has to then pass a special resolution.
Right.
Along with the special resolution, the process also starts for holding a creditors meeting,
Right.
where the 2/3 of the creditors of the company can also decide that the company need to be supported for a voluntary winding.
Right. Right.
The fundamental difference between the two is that in the case of a voluntary winding up, it is presumed that the company is able to meet all its liabilities in full. There are, of course, exceptions that if it can't do
It's a
for a
solvent
particular purpose,
company
it's a solvent company, and
which
therefore
voluntarily-
voluntarily the members are winding
Right.
up. Whereas in the case of winding up by the tribunal, there are certain circumstances for starting off with when the company is unable to meet its debts.
Right. In fact, that was my next question. Focusing on the winding up by a tribunal, what are the grounds or the circumstances in which a winding up by a tribunal can be initiated?
Normally, the most important ground on which the persons file a petition are the creditors, those whose debts the company is unable to pay, and that debt is now defined 1 lakh rupees or more.
Right.
The other grounds which are also available are the grounds of just and equitable, the grounds that the company has been acting against the interest of the nation, like against the national integrity, national sovereignty.
And that's a new provision. It
That
was
is a
not
new
there
provision
earlier.
which has been added, though it's very difficult to define all these terms.
Right.
But nonetheless, they exist, that even in some time that if there is something against the community, there is something against the peace and harmony of the community being violated by the company, this also now has been added as a new ground.
So all the grounds for reasonable restriction in the Constitution
Are
have
now
been put
available
into
even
the-
against the
to
company.
wind up a company.
To wind up a
That's right.
company, for which a petition then necessarily has to be moved to the tribunal.
Right.
And grounds are set out in section 271 from A to G are all the grounds which are available. And now this power has also been given that even the company can also file a petition for its own winding.
Right. So therefore, even if other stakeholders are opposed to it, shareholders could pass a special resolution and approach a tribunal?
Yes, it is possible that some of the creditors or some of the shareholders or some of the preference shareholders may still not like the company to be taken to winding up. But then once the special resolution have been passed, then the process of a voluntary winding up can be put into motion.
Right.
And for that it is necessary, as already stated, that the company must be in a position to declare its solvency, for which a board meeting immediately after the resolution has been passed by the shareholders, board has to then resolve and say that the company is solvent, it has assets by which it is in a position to pay its entire debts, and therefore it will file a declaration of solvency before the registrar of companies.
The board also has to do a due diligence. In part of the affidavit, they have to clearly state that they have investigated, they've gone into details into the internal affairs of the company, and they are comfortable that the company is able to meet its debts. They are confident and comfortable that the company is able to meet its debts fully.
Right. Can we speak a bit about the process? Now, let's say a creditor demands a lakh and is not paid.
See, the process as far as the tribunal winding up is concerned, it started with a process where a petition is filed, it is fixed for hearing, and at the hearing a prima facie case has to be established either by the creditor or by the petitioner under any other ground other than the inability of the company to pay debts. Once that happens, then it's for the tribunal to reach a conclusion that there is a prima facie case for the admission of the petition.
Right.
Once a prima facie case is found, then it has to take one or two or three decisions. The first decision will be that whether it has to appoint a provisional liquidator. If it has to appoint a provisional liquidator, then under the Companies Act, a special notice has to be given, and opportunity has to be provided to the company where the company will be first heard and provisional liquidator will be appointed only after the company has been heard and given a right of hearing.
Right.
I would just like to intervene here to state that just because somebody owes a lakh of rupees does not automatically give that person a right. I mean, it gives a right to the person to go to the tribunal, but the tribunal has a lot of discretion and can say, please pursue your other remedies to get your alternative remedies. So there is a lot of discretion that is allowed to the tribunal to decide whether to go ahead with it or not.
Right. So do you feel the social abuse that has been seen of using the winding up platform as a recovery platform gets addressed in the provision?
To a certain extent, yes, because now there is a special mandate by the law that if the tribunal find out on a prima facie hearing that there is an alternate remedy which is available to the petitioner, then tribunal at the preliminary stage itself can say, I am dismissing the petition and direct you to pursue your alternate remedy.
Right. So therefore, it won't be a matter of course.
Therefore, it will not be in any event this whole process of the first hearing and the final culmination of a final order has to be completed within a period of 90 days.
Right. And also the company also has the right, the company directors and the company representatives and advocates have a right to come back to the tribunal and explain why the company, they believe in their view, the company should not be wound up. So there is an opportunity given, even if there is a prima facie view that there is a chance or there is a view that it can be wound up, they still have a chance to come back. So there are certain protections allowed to the company for this.
Yeah, because we've also seen companies worth thousands of crores being taken to the winding up court by somebody claiming 50 lakhs.
Correct. And then stalling it for months on end. That will not happen now.
Right.
And that is how, the theory of the majority opposing the winding up has taken place in the various courts also. That if at any stage the court feels or the tribunal will feel that there is a possibility that some of the major stakeholders will oppose winding up, then that discretion has then to be exercised in favor of not winding up the company rather than winding up the company.
Right. So then get back to those 7 grounds if they are available and somebody approaches a court. Then what happens next?
Then the next is that if the provisional liquidator is to be appointed after hearing, then the petition is fixed for final hearing. At the final hearing, the tribunal has to reach a final decision whether the company's survival is imminent or the company has become some kind of a nuisance to the corporate world.
Right.
And therefore it need to be wound up.
There is also another provision, new provision in the Act, which provides for selecting a provisional liquidator from amongst a panel. You could say in a way outsourcing the entire function. Earlier,
external,
not the official liquidator, which was the practice earlier, but to a firm or to individuals, company secretaries, advocates. Actually, there is a very wide list that you can choose from. And the tribunal appoints, they will have a panel and they will be allowed to appoint a provisional liquidator who will actually take all the initial steps that are required for winding up. But the ultimate control finally still rests with the official liquidator. But at least it will speed up the whole process, because the provisional liquidator will take a lot of procedural steps required for winding up of the company. Getting the accounts, for example, getting hold of the assets, making a valuation of the assets. So there are lots of work to be done, which will be done by the provisional liquidator who is appointed.
And there are certain more salutary provisions which have now been added to the Companies Act 2013, particularly relating to winding up, is that earlier the final winding up order is passed first, and then the process of the liquidation of the assets started later. But now the new provisions have provided for it that at the time when prima facie case is found out, the tribunal will have the discretion to pass further directions relating to the filing of the statement of affairs, the list of the directors, the list of shareholders, the list of the creditors, and even the statement of financial viability or inability of the company to say, and entire balance sheets, profit and loss account, and the directors and auditors report will also need to be filed immediately, either with the petition or on the directions of the tribunal.
Yeah. Another noteworthy provision relates to the timing. Earlier, it used to stretch for years and years. Now, the tribunal, there is a time fixed under the Companies Act, and the tribunal, even after the first procedures are done, the initial procedures are done, will fix clearly a time limit within which the decision for winding up has to be taken, the winding up process will be completed, and the company dissolved. So it won't take the huge and large number of years that used to take place beforehand. So the timing is clearly outlined in the Act.
Right. So, sorry.
It can also possibly be noted that, as my co-panelist has said, that the whole process of the winding up of or the liquidation of the assets used to take a long time.
Right.
In the process, there is a national wastage of assets. If the company's assets are dissipated in the meantime, that the official liquidator takes over the assets after the wind order, and ultimate culmination into realization of the money from the assets, it was a long drawn process. Today, now with the new liquidators coming into place, which is known as the company liquidators, and this is a distinct breed other than the official liquidator which are attached to the tribunal.
Right.
These are the professionals who will be the company secretaries, the corporate lawyers, the chartered accountants, the cost and works accountant, even the management consultants, and even some of the property valuers, some of the valuers of the assets, which can be notified later on by the central government and put into the category of the company liquidators.
Right.
Yeah,
So
and that is also the reason
this
that
will possibly
no, go ahead, please.
this will possibly expedite
Right.
the entire process of realization of the assets. In the past, we have seen that it is not only the company's assets which are wasted. Ultimately, if the assets which are in the production, they are also producing wealth for the nation. And if we come to a situation where productive assets are used or permitted to rot for long time, number one, that it culminates and stop the production. Number two, that its realizable value gets considerably reduced with the passage of time.
Right.
Therefore, these are the very salutary provisions by which you can expedite the whole process by involving the professionals and paying and sharing with them the certain charges of the fees, etc., by which you can even say that we will give you certain percentage of the realizable value of the assets if you can quickly put the whole exercise into place and then realize the assets as quickly as possible.
And in the interest of governance, all these company liquidators, as Mr. Chowdhury calls them, they have to make a declaration of independence or declaration to say what sort of conflict they have. So if they held, for example, shares in the company, or their relatives work in the company, or any other conflict that they may have, or they have some business or commercial dealings with the company, that has to be declared upfront so that the tribunal can take a view either to appoint them or to appoint somebody else who is completely independent.
A practice question. So therefore, you do see that members of the ICSI do have a practice area that can develop for them now by building capacity to act as company liquidators.
Certainly, at the various forums, I particularly have taken a view that the time is ripe now where you need not to act individually. You can even have the federations of the professionals. In the Federation of the Professionals, you can join hands, that ISI members possibly can join hands with the chartered accountant, with the cost and work accountant, with the management experts, with the experts which are good at valuing the properties or realizing the assets, or even can market the assets when you have to identify a particular buyer for the assets. Now, it's all a specialized process. It requires an expertise, it requires the skills, it requires the knowledge at your end. And if you can have a federation formed for this purpose, and I have been even pressing very hard that to put the actual realization and the value of all these new salutary provisions in the Companies Act 2013, even the individual acts of the professionals, they possibly need to be amended, where you can have the limited liability partnerships, where you can permit other professionals to come in.
The
in your
multidisciplinary practice that is its known.
That's right.
Yes, that's right.
So let's move on to the other type of winding up, which is the voluntary winding up. And can we talk through some of the processes in how a voluntary winding up takes
the process for the voluntary is defined in the word voluntary itself. Number one, that it has to be a decision of the management first. That for some reasons, as I said, as explained in section 304, you have come to a conclusion that the company need to be put for a voluntary winding up. Now, you start the process by taking that decision in the management. The board realizes that the time has come to company for liquidation. Then a meeting is arranged of the shareholders, either to pass an ordinary resolution or to pass a special resolutions. Once that has been done, then there is a declaration of solvency by the board of directors. Then there are the publications in the newspapers. The rules have to be followed for the purpose of filing affidavits, declaration of solvency, affidavits, etc., etc. And then comes the final decision of appointing a company liquidator. Now, this is the process in which the official liquidator is not attached for the realization of the assets. The company,
the board
and the shareholders themselves can take a decision that who will be the right person to realize the assets at the quickest possible pace and at the best price.
Right.
Also, what happens is the central government can decide on the application of anyone that the company, despite it being a voluntary liquidation, still and the declaration of solvency, that the company is not solvent and therefore unable to meet all its debts and pay all its debts, in which case there is also a prosecution and a punishment for the declaration, for making a wrong declaration of solvency, and it can be referred back to the tribunal. If, however, the company is solvent and it's able to meet its debt, then it bypasses the entire procedure of going to the NCLT at all, and it can be done by the official liquidator or the person appointed or the company liquidator appointed, and the company is dissolved without going through the process of going to the tribunal in the first place.
And let me elucidate it further, that this is where the majority of the creditors come into picture. Let me also further clarify that even in a voluntary winding up, when the decisions are being taken by the shareholders and a simultaneous creditors meeting is being called, even the creditors which are in majority can take a decision that it is not worthwhile to keep the company in a voluntary winding up.
Right.
And it was even at that stage that they can refer the matter back to the tribunal, and even a voluntary winding up in midstream can be converted into a tribunal's winding up.
So it's not as if it's completely out of the purview of a tribunal. There are many paths which would take it again to the oversight of a quasi-judicial.
But not necessary.
But not necessarily. In any event, in the end, when the company liquidator reaches a conclusion that the assets have been fully realized, the debtors have been paid, the creditors have been satisfied, the shareholders' contribution have been received,
the final blessing,
final blessings ultimately has to go through the official liquidator, that the final report has to be filed to the tribunal through the official liquidator.
Right. Can I ask a question here? One of my favorite questions is that very often while discussing fiduciary duty of members of the board, the debate and the literature in most Commonwealth countries is, do the board members owe any duty to creditors or shareholders? Now we have 166 in the new act, which says that directors shall take into account the interests of all stakeholders, good general behavior, society, etc. So wouldn't creditors' interests actually now also have to be addressed by board members, particularly when the company is in a winding up mode, either voluntary or by a tribunal?
I will say certainly now because if you see the new provisions and you do not confine yourself to the winding up proceedings, in the end you will see that the management, the board of directors, the officers in default, including the auditors of the company, they are now responsible in a multifarious manner towards the creditors, towards the shareholders and other stakeholders. For example, anything which a creditor feel has not been done correctly according to the fiduciary duty or relationship of the directors, they can even file a class action suit against them if the loss is caused to the creditors.
Right. Vijay, would you subscribe to that in your wide corporate experience?
Yeah, I think, see,
This debate has always been...
I always believe that board of directors, when they sit on the board, they represent the interest of all stakeholders.
Not just the shareholders.
Definitely not. However, in the general meeting, they are allowed to represent themselves. That's always been the dividing line between board of directors and shareholders. So when they sit in the general meeting, they vote as shareholders. When they sit in the board of directors, they vote always in the interest of the company, of all the stakeholders, and achieve a balance.
Right.
That's
And
the
the
whole
bigger
purpose.
point, so the point Mr. Chaudhary made is that the scheme of the act now makes it abundantly clear that the directors or the members of the board have to take into account interests of all stakeholders, not just
Yes,
shareholders.
certainly they have to now think larger. They have to have a more open vision,
Right.
that not only that the shareholders they represent or the management who appoint them to the board, but they have to think of all, not only in the larger context of the creditors, but I will go to the length of saying that even the society at large they have to think.
Right.
For example, they have to think about the consumers. They have to think about the people who use the products of the company. Because if anything happens, now there is a different kind of special courts established.
Right.
There is a liability of filing suit, and now the class action suit which can be started by the creditors, by the depositors, by the members, it will open otherwise a floodgate for the directors' responsibilities.
Right. Sticking to the theme of winding up, but with this same idea, does this, in your view, pose any specific issues that the director should bear in mind when winding up process starts?
Yeah, I think
What
one
would
thing
be-
they need to do very clearly is first to ensure that, of course, if it is a winding up because they are unable to meet their debts, it means that, you know, the company that's 2 feet underwater already. However, if it is a voluntary winding up and they are filing a declaration of solvency, and the declaration of solvency has to be five weeks before the holding of the meeting of creditors, which is held a day after the meeting of the shareholders, they need to be very clear that the company is completely able to meet its obligations. Because the consequences of not doing their proper due diligence is pretty heavy on the directors. There is imprisonment or fine or both.
Right.
I will even add to this that even in a tribunal's winding up, now since there is an obligation simultaneously with the filing of the petitions, that statement of affair has to be filed by all the directors and the management of the company. It is imperative on their part that there is no malfeasance, there is no misfeasance, there is no embezzlement of funds, and there is no accounting process which can lead to a fraudulent practice against the creditors or against the members or other stakeholders.
There is a specific obligation which is cast in the Companies Act on the members of the company, on the directors in particular, to ensure cooperation within 30 days they have to give all
As
the
a
documents that are
statutory
required. There is
obligation
a
to
statutory
assist.
obligation. So it's not just a fiduciary obligation or something that is up in the cloud, but very clearly cast in stone in terms of what their obligations are in case of even a tribunal winding up,
Which
leave alone a
brings me to
voluntary winding
the
up.
other important aspect in all winding up situations. What does the Companies Act 2013 do in the space of fraudulent preference or transactions in the immediate preceding past before a winding up happens?
There is, in fact, more closely watch imposed now, in the sense that when you look at this kind of transactions, the statement of affairs is available even before the final winding up order is passed. All directors' addresses, the director's responsibility, the statements, the balance sheet, the profit and loss account, all financial data and the statements are already with the tribunal.
Right.
And therefore, the tribunal, in addition to checking out all this financial data, also can investigate that if during the proceedings of the winding up, they find out that the practices of the company carrying on its business is fraudulent either to the creditors or to the shareholders, or its affairs are being carried on which are prejudicial to the interest of the company or the interest of the members or the public interest, then the responsibility can be cast upon the directors even before the final winding up order is passed to bring in those losses or those funds back to the company.
Also, if in a period of 6 months prior to the passing of the resolution at the board, not even the shareholders, for deciding on winding up, if the directors or the company has taken any steps to transfer any property out or to take any steps to give a person an advantage which would not have had under this circumstance, then the tribunal can completely reverse all of that and make it void, make all those transactions including transfer of property, movable and movable property, void.
Now, reconciling that with how day-to-day business decisions get taken, would you then advise company secretaries that if a company is not in a position where it has to be wound up, but if it's entering a zone of financial stress, how much should the board be involved in decision making, and how much should company secretaries stress on involving the board rather than a board authorized management to do transactions which could later be called into question as being outside the ordinary course?
See, according to me, the company secretary and the board members have to be very careful now in the new regime of Companies Act 2013. Particularly, you have to keep now in mind that other than that you are an officer in default for every conceivable offense under the Companies Act, particularly in the case of a winding up, if any fraudulent transaction is found, other than prosecution, you become personally liable of making good the losses.
Right.
In addition to that, as I have already said, that not only that you make good the losses to the company, but even the members can sue individually the directors and the company in a class action suit.
Right.
And therefore, the damages could be exemplary now.
Right. So, would you have some perspective on this, and what sort of capacity building one will have to do?
No, I think it is, what's called the business judgment rule, that you cannot stop all the operations of the company just when the company is entering into the danger zone. However, when it gets into the danger zone, then the antenna of the directors and the management should also be alerted at the same time.
Right.
The word used is fraudulent preference. So any action that is done in good faith in the interests of the company in the normal course of business will not be deemed as fraudulent preference.
So, the prima
So
facie
it's the
case
mind,
has to be made
it's a mens
before you
rea
defend
really.
that it's not fraudulent preference, or would all transfers be first assailed as fraudulent preference and the owners then shifts to
See,
show it
somewhere
as
there is a presumption in law
Right.
that all transactions which have been done within a period
immediate
of 6 months,
past. Yeah.
immediate past, that is the period of 6 months, it will be presumed that they are in the fraudulent preference. All other transactions beyond that will depends upon their bona fide.
Right.
It will also depend upon that there is a good faith transaction. It will also depend upon whether they are the arm's length transaction or they are the transaction between the related parties. This all have to be examined on the individual cases.
Right.
It is very difficult to make a general sweeping statement.
Right.
Yeah.
But
However,
again-
the onus will clearly be on the directors of the company because all eyes will be
demonstrate
upon
bona
them to
fides.
demonstrate their bona
Particularly
fides.
since you don't know whether in the next 6 months a petition is going to get presented by somebody or the
Correct.
other or not.
Yes.
And it goes to 1 year for cases of transfer of movable and immovable property.
Right. So before we wind up, can I request each of you to summarize, in your view, what this does, chapter 20, in terms of the role of companies in society? Are they going to be more trustworthy business partners, or are they going to be more difficult to do business with? And particularly in the context of the very specific stringent provisions we've just discussed in the last half an hour.
See, one thing I can say with certainty is that it will definitely bring some transparency. There will be no more night by fly operators where the companies will vanish, the directors will vanish, assets will vanish. So it will bring a corporate transparency, because the responsibility of maintaining the transparency is interlinked with the filing of the petition itself. And it will therefore lead to a situation where if the petition is filed, then you should be in a position to immediately put your house in order and say that there is nothing so terribly wrong with the company which will catch you off guard as and when the final winding up order is passed.
In my view, there's protection given both to the company as well as to the creditors. As long as the company is doing business in a straightforward manner and does not intend to cheat its creditors, even if sometimes business judgment says that you can go wrong, business fails. In such situations, the company will go into winding up. The creditors may not get their money, but nobody is going to blame them. There is a protection that is given. However, if you've been fraudulent, if you have not managed the affairs of the company in the manner in which you should have managed it, then the winding up is, first of all, is going to be much swifter now, because it's going to the NCLT. There is a lot of leeway given to the companies to appoint provisional liquidators, and they've also been given a fair amount of authority to get into the affairs of the companies. So in my view, it's going to be swifter, it's going to be speedier, of course, and definitely, as he said, more transparent.
Right. Thank you very much for this very interesting and lively discussion we've had.
Thank you.
That's all we have time for on this episode. Do read up the provisions of chapter 20. They're a really exhaustive set of provisions. The idea of this video is to give you a nodding acquaintance with critical aspects of the chapter. Thank you very much for listening to us. Thank you.